Thank you, everyone, for joining us. For those of you that have been on these before, we'll be going through our standard format, reviewing all of the strategies performance in Q2. And then as some of you may know, most of you may know, we made some updates to the long volatility strategy starting July 1st. We sent an email out that to our investors in that strategy, and we had a number of questions about that. So we'll have a special little dedicated section at the end to cover that. So if you have any questions, feel free to pop them in the chat. And if we don't cover them at the end, we'll be sure to go back. To start, this is for information purposes only. This is not seen as solicitation. Futures and options trading involves substantial risk of loss. Past performance is not future performance. And with that, we can get started. So the cockroach strategy was flat-ish for the quarter. Just as a quick reminder on this chart, the percentages you see here are sub-strategies shown as percent of fund level and contribution. So this isn't their standalone performance. This is their contribution to the overall fund performance. As you can see, the stocks and the trend sub-strategies were the bigger winners with modest gains of around 3%, while income and the volatility sub-strategy were the losers with sort of roughly offsetting amounts that ended with things being flat. The story for the first half of the year, Q1 and Q2, has just been U.S. equity performance and resilience in the face of a rising interest rate environment. U.S. stocks have done good in particular, posting somewhere between 1.5 and 2x of most of their emerging and foreign counterpart gains. And that's really what drove the performance in the stock bucket. The trend strategy we'll talk about more in the trend section, but was able to find some gains across different things, including the short bond trade and some currency and agricultural trades as well. As I said, cockroach strategy year to date has posted a modest gain, with most of the gains coming from stock and the fiat hedge buckets. And as mentioned before, we are using a US-based 60/40 index in our comparison here, and US stocks have done, as I said, particularly well up until this point in the year. Taking a bit of a longer step back, we see here, I was working the slides on two things here. I apologize if I get off sync. Y'all can, Jason can ping me. But this is the sort of year-to-date performance I was mentioning, with most of the gains coming from stocks and fiat hedge. And as I said, this is the 60/40 index with the US focused, which has done quite well. Taking a step back, looking at cockroach since inception versus, again, the same US 60/40. They are in roughly the same place. Cockroach did its job in 22, really truncated a lot of the drawdown we saw in a sort of classic 60/40 approach. And then 60/40 has really caught up again, sort of through the first half of the year. I think at the end of June, the S&P was up somewhere in the neighborhood of 15 and the NASDAQ 30. So just sort of that strong rally in the big tech companies has driven most of the gains there. That means our international exposure, our international diversification has not been particularly helpful compared to an all US focused stock strategy. And I think, we continue to feel good about how the portfolio is positioned overall. I think that the changes to the volatility strategy are the main thing we'll talk about and update, but otherwise have been, very pleased with how everything's done. Jumping in to the trend strategy, another just quick reminder, the trend strategy as a standalone is run at 1.5x the exposure of the sub-strategy inside of cockroach, which is the difference for the numbers between the two. March was a tough month for trend. The big reversal in bonds gave back a lot of losses. I think the April, May, June period is a nice microcosm of what we're trying to get out of the trend strategy and performing. It bounced back pretty impressively in April, but wasn't sort of a standard bounce back of, exiting and getting back in the same positions. Most of the bond positions were exited in March, and April's gains were driven by commodity and currency markets. Sugar was up 21% for the month, and they were also able to capture some down moves in soybeans, corn, and wheat. In May, things rotated more to be currency focused. We saw gains in Japanese stocks and bonds while being short the Japanese yen. And starting to see that kind of divergence we've seen between some of the central banks, particularly Japan, is a sort of target rich environment for the trend followers. When all the central banks are acting in coordination and lockstep, there's not as many trading opportunities for them. Whereas now we're seeing, or in May, we saw sort of that increased divergence between Japan in particular and other central banks. So that has been a benefit for the trend performance. And then finally in June, we did see the short bond trade start to come back. So the positions that exited in March were mostly back on in June, and that was the main contributor. So as I said, I think a nice microcosm of sort of what we would hope to get out of trend, that we saw gains across a variety of markets, commodities, currencies, fixed income, as well as a variety of look-back periods. The trades they got out of in March, they got back into sort of over time with the bonds in particular. Jeff, Jason, anything y'all want to add?
No, nailed it on the trend. It was great to see, right? Classic trend client bemoaning is that it gives, right, 3 steps forward, 2 steps back. That March and Q1 really seemed like the 2 steps back after a great 22. So could have just been whipsawed there in the bonds and kept losing, but it was great to see those other markets step up and fill in. I think the focus of the portfolio to have managers that have at least 40 to 50% in commodities helped out there. So we had a little more exposure than the indices and others that are a little bit more in fixed income and equities.
I just want to highlight too that with the when we're referencing bond strategies going long and short with these trend followers, obviously they're trying to capture the trends, and at turns they might get whipsawed a little bit. But what's great is they don't read headlines; they just continue to trade with the trend. So as we see a lot of headlines of what people are predicting is going to happen with the bond markets, they continue to follow the trends. And like you said, they could get whipsawed at turns, but then they'll jump right back in on the trends as well.
And just one point of clarification, as you said, that they're long and short the bond prices, which are inverse of the yields normally. So if we're short bonds, we're short the bond price, which means we're long the interest rate.
And we did have one question about sort of why we use trend as opposed to a buy and hold commodity. Obviously the last few months are particularly good example of why that is, but broadly, of course, there will be periods where buy and hold commodities outperform sort of our trend approach. But as Jeff said, we have a commodity focused trend approach to try to look for managers with 40-50% in commodities. So we're getting all that commodity exposure, but we do like having that diversification outside, the ability to do currencies, financials, other asset classes. I think is lets us get much of what we'd hope out of a buy and hold commodity with catching those big run-ups in commodity prices, but also some really helpful diversification for other periods.
Yeah, and I'll just jump in quick there. I think that question referenced the Credit Suisse report, and it had some stats on commodities over the long term, the total return of the commodities, which includes the T-bill. So I think embedded in that question is, hey, if you're getting 5% in T-bill interest, why not just hold long commodities, get that tailwind? Just stated plainly, we think there's way too much volatility and downside in doing that. And if you can be long and short the commodities plus the T-bill tailwind, we think that's a way better risk-adjusted return. So I think I think the statistics, I don't have in front of me, but the commodity index alone, just buy and hold, is maybe 75% drawdown versus the trend indices are 30% drawdown. So for me, it's about twice as risky at least.
That was perfect. That was exactly what I was going to say as well. Well said.
Great. So moving on to the volatility strategy. Volatility strategy posted losses in Q2, kind of what we saw in volatility markets. April seemed like kind of more of the same. The VIX hit at that time 2023 lows, sort of in the 17s, and that kind of continued to decline throughout the quarter. It posted a new COVID low of under 13, 12.91 in June. So signaling sort of continued comfort in the equity rally being sustainable. We're seeing a bunch of things going on. I think some investors have sort of started to give up on hedges post the 2022 slow drawdown, where a lot of volatility strategies perform poorly. And we've also started to see the reemergence of short volatility and tail risk selling strategies that were sort of very out of favor following March of 2020, but are starting to make a comeback. So I will talk more about the overall volatility later, but to dive into the individual performance of some of our sub strategies, kind of what we've seen for this year is the dynamic VIX was able to capture some gains at times and has been sort of flat-ish on the year. Sort of same story for short futures. Given the decline in volatility I noted, both the rolling puts and the long options buckets have posted somewhat predictable losses, though I think the extent there is probably greater than what we would have expected, sort of given the volatility environment. And of course, volatility could remain quite low for some time. I think that's something we're a little bit more something where the changes we've made in the portfolio, I think, are designed to account for that possibility. And we'll talk about that in a second. Anything on the volatility strategy, Jason, Jeff, over the last few months you want to add or any color?
Sure, I'll jump in first. Just say that the real dynamic in Q2 there especially was, it feels like the floor on volatility that's been in place since COVID really got broken through on the downside. So Taylor mentioned vol sellers are coming back in a big way. B of A was out with a report showing that short gamma has increased to levels back from, I think, 2018. So really it's become more of a two-way trade for that dynamic VIX and the short futures, where for most of that post-COVID period, it was more of a one-way trade with a floor on the bottom of the VIX.
I think related to what Jeff is referencing as well, that we'll address with the portfolio changes, is like when you're going through a medium vol environment, it looks very differently than a low vol environment. And we've kind of seen these oscillations this year between medium vol and low vol environments, and people positioning accordingly and kind of getting whipsawed, which has led to more bleed than we appreciate, or we would expect or we like to see in that environment. Some of the color from our managers were all relatively similar, obviously being very tough sledding this year. For any sort of long board portfolio, even the dynamic VIX, the relative values had, because of those whipsaws going from medium to low back to kind of medium vol environments. April was very quiet, and fixed strike vol collapsed in April as it did as well in June. And the idea, once again, fixed strike vol is the price you pay, right? Like the VIX index is a floating strike vol. That's not necessarily the price you pay when you're going out in time. When you're looking at your options, that's more represented by the fixed strike volatility. And that collapse, like I said, in especially April, but as well in June when we saw SPX, just rip higher. The good news, semi good news in this front, is puts are the cheapest we've seen in almost 18 months. So we're getting closer to the kind of the pre-pandemic levels, but we're going to buy, deep out of the money puts or out of the money puts. But also we always like to reiterate, you can go years in a low volatility environment, but at least the bleed on those puts is getting cheaper for the convexity kicker that you would expect in case you did jump from a low vol to a high vol environment. To repeat, some of the things that Taylor and Jeff were saying, from one of our managers, is like long-term implied volatility has been crushed back near those pre-COVID lows. They don't think they can attribute this to one cause. Rather, it's likely due to a confluence of events, including the incremental growth we're seeing in structured products post 2020, especially structured products in the US, even more so than Europe and Asia now. investors giving up on those hedges, post 2022, when they didn't get the payout for that deep out of the money, vol or vega. And then, as Jeff was saying, the reemergence of the short volatility and tail risk selling strategies by institutional players and multi-strat funds. We're also hearing a lot of chatter around the idea that there's been high demand amongst the multi-strat for vol related strategies, and most of those tend to be short volatility. So we're seeing a lot of institutional players come back, a lot of institutional players allocating to hedge funds in the short vol space. So that kind of disappears for those few years after COVID 2020, and then saw similar things in 2008 through 2011, where the short vol disappeared, and then they come back kind of with a vengeance to try to put on those short volatility positions again.
And then moving on to the volatility in stocks strategy. As I say, given the performance of the volatility strategy over the year, the volatility plus stock strategy has struggled as well. We are making some updates to the volatility strategy that I'll cover next. We've also made some updates to the long volatility plus stock strategy, as everyone is likely aware, because we go on about it ad nauseum. The diversification and rebalancing is very sort of core to our approach and how we use volatility inside the cockroach strategy and sort of portfolios more generally. One of the things we found in our research is more rebalancing, more frequent rebalancing is better. Given our current setup with managed accounts in the volatility strategy, monthly rebalancing is just logistically the most frequently we can do. It's not possible to do it anymore than that. So we have been looking for some time for ways to add a daily rebalance strategy into the long volatility plus stocks, and found a manager we liked that was able to do a daily rebalanced S&P plus hedging program, a convexity overlay program that we've implemented inside the volatility and stocks strategy. So it contains now the 100% long S&P and 100% exposure to the volatility strategy that it's had historically, as well as this daily rebalanced long S&P plus hedging overlay. And the intent here with the daily rebalancing is that we're going to be better able to lock in the sort of short-lived vol spikes that then mean revert, and just generally try and smooth out the equity curve in a way we're not able to do inside the volatility strategy. I'll also note this does make the strategy a little bit more fee and capital efficient for our investors. There's some additional exposure in there now that we're just charging fees on the cash basis. So there's no additional management fees on the additional exposure, and we think it will make the product materially better going forward. And before I jump into the volatility strategy updates, Jason, Jeff, anything else y'all want to add on the volatility in stocks changes?
I just address one of the quick questions that came in the chat. For anybody who has any questions, please put them in the chat. Asking why wouldn't we use maybe rebalancing bands for a strategy? Obviously, we're big fans of rebalancing bands. We talked about it many times, the way Harry Brown structured its portfolios. But like Taylor was addressing, given the functionality of offering monthly liquidity to our clients, we have to rebalance the portfolio on a monthly basis for the most part. But this is why we think, even to reduce that timing luck on the first of the month, we like this intra-month ability to rebalance the portfolio when we've seen historically a lot of those vol spikes intra-month. It's still based on, a little bit of bands intra-month, and we're not doing it on a very discrete basis, because you always have to, the more times you rebalance, you have to worry about your transaction costs. So it's trying to weigh those in conjunction and figure out the best way to kind of diversify our rebalancing timing luck.
Great. And then I'll speak now about the volatility strategy updates. If you had a question and I don't address it here, please put it in the chat, and we'll go through the outstanding questions at the end. So I want to step back and just talk a little bit broadly about how we've thought about the volatility strategy historically and our approach, and then talk about kind of the evolution of our thinking. Broadly, there's kind of, we think of three sort of volatility environments. There's low volatility, high volatility, and then what we call like a medium volatility or echo of volatility sort of transition period. Between the two, low volatility would be something like sort of the 2013 to 2019 period. High volatility would obviously be something like sort of Q1 of 2020 with the big sell-off. And then the sort of medium volatility, echo of volatility period is, kind of what we've seen since that Q1 2020 sell-off. And as Jason mentioned, I think there's a lot of changes in the volatility market since this time, but sort of post 2008, also kind of a medium volatility, echo of volatility environment. Our goal for the volatility strategy has always been to kind of do okay in these lower volatility environments, and get something flat-ish, and then see a meaningful pop in these high volatility periods. One challenge with volatility strategies is it's just very hard to know how an individual manager or strategy is going to perform any of these examples. There's a manager we've worked with that is more designed to do sort of like a relative value, kind of do okay most of the time, that had a huge pop and big returns in March of 2020. They didn't expect that. They wouldn't sort of advise anyone to rely on that in the future, but that can happen. And obviously, of course, the inverse can happen. So we do shock tests. We have sort of various things we do internally to try and gauge that. But there's sort of, significant error bars, to how we do that and where that goes. So sort of looking at what we've seen since the volatility strategy launched, there's a big decline, pretty precipitous decline of volatility in sort of late 20 and into 2021. Sort of given that decline, the performance wasn't, too far out of bounds what we'd expected. It was a very challenging environment. And we actually started looking into the volatility strategy more in 2022. And just, one thing to note is, with the volatility strategy or any strategy really, we're never sort of looking at going, yay, this made money or didn't make money. We're looking at how did this perform in the regime we're in, sort of relative to our expectations. So, the volatility strategy struggling isn't necessarily a bad thing, depending on the regime. Though, as I noted, sort of the 2022 performance did get us thinking. So this is the 2022 volatility strategy performance. And there's a few interesting things I want to point out. One thing, just we have historically categorized the sub-strategies as the long options, dynamic VIX, short futures, and rolling puts. You can see those in the bottom of the chart here. And, historically, our philosophy has been we were going to sort of hold as many dynamic long options as possible. And the idea there was, there's maybe a bit of negative carry, but because they were dynamic, they were coming out of the markets, they were sizing their position, there were some alpha opportunities there. They could have some pops in sort of risk on call markets to offset some of the losses, and then also have that pretty significant convexity in a risk off period. When we were due diligence these managers and looking at backtests, that was what we saw for much of the performance, sort of the late 2010s. What we saw looking in sort of 2022 was a few things. One is, the dynamic VIX and the short futures, did okay, but really should have done better. The dynamic VIX in particular would have expected to do better in that environment. The rolling puts bucket was, our sub-strategy was really a surprise. Did, sort of materially better than expected. And then the long option sub-strategy was really sort of where things struggled the most and things didn't sort of perform to our expectations. So sort of after 2022, what we were seeing was, the long options had more negative carry than just the pure tail risk, and sort of weren't popping as we had expected when you did get those relatively brief pops. And so, we initially sort of relied on some of the alpha of those long options managers to mitigate some of the carry cost of those long options positions, and that just didn't materialize in 2022 or into 2023. And so the short futures and dynamic VIX pieces did okay, though not as well as we would have hoped. And the static tail risk did quite good. So kind of the learnings and changes we made from this. As I said, previously, long options, we were kind of trying to get two things out of them. We were trying to get both that sort of convexity in a sell-off event, as well as being able to capture some of the smaller volatility pops in relatively calm markets to offset some of their carry costs. And that had worked quite well from what we saw prior to 2020. We found it just wasn't working post 2020, and there was some just a lack of how we sort of had expected that to perform. And then we made some changes as a result. So when we look at the long options managers, they're taking some timing risk compared to the tail risk managers, but sort of not getting those pops we'd hope. So we kind of bifurcated the portfolio a little bit. So we took the dynamic VIX and short futures, and we merged those just into a single relative value sub strategy that's more focused on pure relative value. So unlike sort of how we'd approach the long options we were hoping them to get a little bit of relative value, capture a few pops in vol, and sort of have that convexity, that segment of the portfolio is a more pure relative value. And our expectation is they're going to chug along in sort of risk on times and help offset some of the cost of those options, and then mitigate or truncate drawdowns in a big sell-off where we have those option managers really kick in and the convexity start to kick on. So we took some of our long options exposure. We kept what we felt were the best managers in that bucket, and we moved the rest of the allocation into the relative value sub-strategy and tail risk sub-strategy. We also added a new tail risk manager that has some deeper tail exposure, as well as doing cross asset class volatility. So to summarize a bit broadly, instead of trying to get the long option sub-strategy to both sort of carry flat and have some convexity, we sort of more clearly delineated the role. So we have the more pure relative value managers and the more pure tail risk managers. Sort of going forward, our expectations are this is the performance should be sort of closer to what we'd initially set out to do in a low volatility environment. Our relative value sub-strategy should do similar or better to kind of how we'd historically expected the dynamic long options to do, but they're really just focused on that one thing. They're not trying to do two different things. And then in this sort of high volatility sell-off environment, as I said, we've added a new tail risk manager, and we think they have a lot of that convexity there, and we're not taking any sort of the timing risk associated with the long options with the managers coming in and out of the market. That exposure is on all the time, which we like as well. And our expectation is those are going to sort of symbiotically offset each other in a risk on period while maintaining that convex exposure in a risk off period. So it's very early. Sort of so far, what we're seeing in the August performance is that's kind of working as expected, with them sort of offsetting each other. And then I'll make one final note, and I'll throw it over to Jason for some additional comments. But the reason we rolled out these changes on July 1st is it takes us about, once we start to do sort of research and we need to update our PPM, there's generally about a 6-month lead time to make any material changes to the portfolio. We have to, I won't go through all the details, but get new capsules for every managers, update the performance, have submitted to the NFA. And so we started working on this beginning of the year. And that's kind of just about how it looks. So, every year we're looking at those changes and what we can make. We've made updates in the past, but this is sort of our most material one. So we wanted to discuss a little bit. With that, I'll throw it over to Jason. And if anyone has questions that weren't covered there, please put them in the chat and we're happy to discuss them.
Yeah, to kind of summarize what Taylor said, when we originally launched our long volatility fund and had our back test and everything, we actually launched with 5 managers in April of 2020. Now we're up to 14. So we've always been assessing, kind of our aggregate exposure and our diversification. And we're always trying to balance, delta, vega, gamma exposures. But to summarize what Taylor's saying is we reduced some of our exposures to the long optionality of the book and added some of that exposure to the relative value or dynamic fixed trade, what we call it historically, but still kept a lot of the tail risk options just in case, you have an exogenous event. We feel like we even have more exposure there. So we feel hopefully the portfolio will carry better. Because, for example, what we saw is when, we were looking at constructing these portfolios in 2018, 2019, 2020, like Taylor's referencing, we're coming from a low vol environment. And that was a kind of good environment for those relative value volatility traders, especially ones that we always searched for that had, a little bit of wing protection or lean more long volatility. What happened, I think, is in this echo volatility or this medium vol environment, as we're oscillating between medium vol coming down to low vol, popping back up into medium vol, is they kept trying to, protect themselves and then, eke out their pairs trades, protect themselves, eke out their pairs trade. And they kind of got whipsawed a little bit back and forth. So we moved our relative value strategy to be much more market neutral than necessarily leaning towards long vol, because we think we have the right exposure with the long options book and then the tail risk book as well. So that gives us that kind of balance that we're looking for. And so far we've seen that in the last month or so when we've adjusted those balances, and hopefully that'll work better moving forward. The other thing that Taylor's referencing when he was showing 2022, there's a lot of granularity there. I mean, the rolling puts did well, as you saw, the portfolio was up, going into, Q4 of 2022. But then, those, Vega or Gamma positions, they can expand and contract pretty quickly on you. So the gains you get from there can kind of get erased too, depending on, the length of your tenors. If you're buying options, 6 to 12 to 18 months out, the P&L expands and contracts pretty quickly. And so you can kind of see that happen in the 2022 scenario. The other thing is, as we've discussed prior, is, our long Gamma positions on the long options book did really well in 22, and those are getting, relatively hurt here in 23. So like we're not seeing, a big pop out of any Vega positions. Hopefully, vol's coming back down to a place where we can be buying those even cheaper and maybe capture some pops here and there. Gamma and realized vol has been struggling a little bit. And then on the Delta side, obviously with S&P taking off, the Deltas are running away against us a little bit. So that's kind of the story we're kind of seeing in 2023 here. And like you said, Taylor said, we were addressing our exposures back to 2020, 2021, really started, really working on this in 22. And then it's the prep time that it takes with the NFA and getting everything approved and being able to move these positions around, but also having the AUM to allocate to the managers we want to and their minimum size requirements. So it's a bit of a 3D puzzle that we're constantly working on. And we always have to be thinking, 6 to 12 months ahead.
Great. With that, we will jump into some of the outstanding questions. Excuse me. Before we get to that, I did one quick business update. We are excited to welcome a new team member that started with us earlier this year and is going to be helping us in sort of general operations, regulatory, and just keeping all the trains running on time. So CJ Andrews joined us in March. So we're excited to have him and to have some additional time to focus on the portfolio as he's sort of taking over some of our day-to-day operational responsibilities. So sort of outstanding questions. I think we had a friendly trolling question from Jason of when will Powell pivot? Our long-term rates going up and down, and our price target for gold the day after Labor Day, which is our favorite question. So do you want to give your price target for gold the day after Labor Day, Jason? I know mine.
Yeah, obviously, Jason Josephiak is trolling us a bit there because we know, we don't have a crystal ball. We don't predict anything. And that's what we believe we construct our portfolios because nobody can predict the future. So obviously we don't know what the gold price is going to be post Labor Day. I think there was another question related to that by Gonzalo in there asking about curve steepeners and when they're going to flip. We let the global macro pontificators make their guesses when those are going to happen. Like I said, we don't have a crystal ball. We cannot predict the future. We just try to construct a portfolio to kind of muddle along in any, kind of global macro environment. And we don't second guess when things are going to happen.
And then we had a question from John about what would cause equity market volatility to rise given the domination of big tech.
Yeah, I mean, we've seen obviously everybody knows just a few names of big tech is what's moved, primarily the NASDAQ and quite frankly in the S&P as well. Obviously that can shift the other way. What would be predictors of, big tech having a crash? That once again, that's the global macro pontificators, but we try to hedge our portfolios when we don't know what scenario can happen. I mean, in 2022, we saw that medium vol environment because bond vol was so high. And so people were worried about equity vol, and equity vol didn't really do anything. And so once again, it can come back to a lot of things from, a deflationary bust, maybe with private tech that cascades into public technology, but we really don't know the answers to that. And so we just try to hedge that S&P risk.
I'll throw one in there. Right. I'd rather have 50 stocks at risk of some CEO change or a product flop or fraud or a lawsuit or something that hits their stock price and causes the whole market to have volatility, then, right, in this scenario, we have basically 5 stocks that if any of those things happen and cause some big losses in one stock, it's going to bleed into the index even more than usual. So I think it's even more ripe for volatility than it was in the past.
And then we had a question from Ed. Looking back over the last 2 years, what 2 things would you have done differently? And have you taken any steps to address those? I think a lot of the volatility stuff, I think that's probably been sort of some of where our biggest learnings are. I think, in the back test we saw, we just didn't see a period like the one we've experienced since then. And, we've learned from that and are adapting. I think, broadly the rest of, Cockroach has performed more or less as expected, if not better than expected. The trend strategy performance since launch, we've been very pleased with. Overall, it's good. I think our cheeky answer to this question was we started fundraising in December of 2019, and it would have been very nice to have a live track record starting in January of 2020 rather than April of 2020. As some of you can imagine, the interest in long volatility strategies from January of 2020 to April of 2020 went up quite a bit. So suddenly a lot of phone calls that hadn't been returned got returned over that period. But that is how things go.
I think it's worth noting, right? Like the classic would be, we shouldn't have gone long bonds and Cockroach. We should have waited till Fed was done hiking rates or yada, yada, yada. And we shouldn't have diversified into foreign and emerging in the stock bucket, right? So if we had that rear view mirror, what would we have done differently? If we were looking to make the most money possible, we would have eliminated those 2 things. But I think, and Jason can speak to this, the idea is that we don't know what's going to happen, and those are in place in case the other path dependencies happen and those scenarios don't happen. So I'll just tee Jason up there for, it's easy to look back and say, we shouldn't have diversified, but the diversification is there for a reason.
Yeah, hindsight bias is amazing. There's a lot of things we could have gone back and changed. Like I remember, I'm not even going to get into that. So sorry, I'll skip that one. We can go to the next one, Taylor.
Yeah, I think we get asked this question periodically, but I mean, we would have bought the bottom of everything and sold the top of everything is what we would have done in retrospect. But knowing that we can't do that, what would we have done differently? And I think mostly sort of the stuff we discussed in the volatility strategy are the big things some of the big things we've learned.
When our friends at Alpha Architects wrote a great piece that if God was a trader, hedge fund manager, investor, he would get fired because it was like basically he would have bought Amazon coming out of the tech bubble, but then with the declines, nobody would have held it and everybody would have fired him.
And then, we had a question about commodities that we covered, I believe, and the trend strategy. And then Jim asked, do any of the vol managers take shortfall positions tactically? Jason, do you want to field that one?
Yes, and it's a very nuanced question. Hey, Jim, how's it going? Primarily, you're going to see that in our dynamic VIX, or we call it relative value bucket now. Now that that's more market neutral, you're going to see that stance in both VIX and options market, where you're trying to balance those implied short vol positions with your long volatility positions and trying to get your ratios right. So you're going to see that primarily in the dynamic VIX positions. In the long optionality, especially tail risk, we just want to see them buying options kind of across the book. It can be some little tactical nuances in there as well, as I'm sure you and I have discussed many times, but you're primarily going to see that in the dynamic VIX relative value, but it's still trying to have a market neutral positioning.
And then we had a question, would it be possible to tell us on the monthly newsletter when long vol is cheap to rebalance tactically? I think this is an important question for a couple of reasons, but I think the whole premise is we don't know when it's really cheap. And I think actually sort of like post Q1 2020 is a really interesting example of this. And we had a lot of discussions internally about sort of a second leg down. So obviously volatility went up a lot. February, March of 2020 . And, there were some volatility managers that said, okay, well, the VIX has gone up to, near historic highs and we're going to sort of take it down. our feeling, given that we sort of constructed this portfolio for ourselves and our families and the way we want to do it, is, you don't know when there's going to be a second leg down. We haven't seen one in the US sort of in the modern era, the last 50 years. But, the fact that the VIX has never gone to 120 doesn't mean it can't go to 120. It just means we sort of haven't seen it over that period. So, the nature of the strategy and the approaches, we are acknowledging we don't know when it's particularly cheap or when it's particularly expensive, and we're trying to keep that exposure on in the face of anything that can happen. Jason, do you want to add anything to that?
Yeah, it's one of the things about this industry that is not our favorite thing, is like we try not to hammer on these ideas that options are cheap or expensive, because we believe the only way to really know is in hindsight, right? If an event doesn't happen, then options were expensive. If the event does happen, they were likely cheap as soon as you monetize correctly. So we don't really try to hammer home this cheapness idea in options as much as other managers would. And then related to that, the flip side of what Taylor's saying is you don't know how much vol can expand on you, is you don't know how long vol is going to be suppressed. So if you're looking for a cheap environment or low vol environment, you can go through 2017, 2018, 2019 and not see any pop in volatility at all. I mean, you had, a little bit in Volmageddon in 2018, but 2017, 2019 were just, single digit vol environments. You're just questioning, are the markets even open? And so that's why we think it's really hard to try to time these markets. So related to that, if you're not in one of our cockroach funds or long volatility plus stocks, we recommend our clients rebalance quarterly. It just makes it a little bit more efficient for them, given the monthly liquidity. But also going back to the comment about Swedro or Harry Brown's rebalancing bands, you could also use some rebalancing bands for you too. If you see, your S&P or your global stocks position, really, crushing it, over a quarter, maybe it's time to rebalance with some vol and vice versa. So that's the way we address it, not really trying to figure out if long volatility is cheap or not, and because it can stay cheap forever or it can pop at any second on you. It can expand much more than you ever realized. Another way to look at that, I think, is there's actually a great note for one of our managers today talking about just our ability as human animals to be able to perceive risk and small risks. And, like if we haven't seen a flood in 100 years in an environment, we don't really buy flood insurance because we don't think we need it. And then especially if they build a dam in your environment, you think, oh, it's always small floods now. And so the equivalent would be, trying to hedge against 5 to 10, 15% drawdowns, as we see a lot of like the hedged equity portfolios do. And then they're missing out on a 30% drawdown that would really just kill your ability to compound wealth. And so those are the things we constantly think about is, you can go, a decade in a low vol environment until you have, an event happen that would just destroy your purchasing power for the following decade. And then Taylor, I wanted to address to the long vol and stocks again real quick, is that, it's, classically we ran our long volatility strategy overlaid with 100% exposure to the S&P E-mini futures. And so what we did is with that overlay is we overlaid an additional 100% to the S&P E-mini futures with the intra-month rebalancing as a full hedged overlay. So you essentially, like Taylor said, you get a much more capital efficient exposure. So the one way to think about that is you're getting 200% exposure to the E-minis and a 200% exposure to long volatility. Except that, with that hedging in place and that deterministic hedge and rebalancing intra-month, I think the return stream is going to look pretty different than looking at just like a long S&P position. It's not going to be quite or a balance of S&P and tail risk. So even though you're getting that more exposure, we feel it's balanced really well, especially, historically we've been even overly defensive. So I think the return stream will look a little bit different than necessarily being, 200% long the S&P.
Great. I think that's all the questions we had. So we will wrap up a few minutes early, but thank you everyone for coming. This is recorded and we will be posting and distributing the recording. So if you want to go back and look at anything, that should be out later this week. Thank you all for being here, and we look forward to seeing you again.
Thanks, everybody.
Thank you.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.